Hey everyone, and welcome back for the last session of our webinar day. I am pleased to introduce Alice Lin to talk about Inflation Reduction Act climate tax incentives. Alice Lin is a senior tax policy advisor for the Senate Finance Committee, which Senator Wyden chairs in the Senate. She handles energy and environmental tax issues, among other issues for Senator Wyden. Prior to joining the Finance Committee, she worked on the Ways and Means Committee, the counterpart to the Finance Committee in the House of Representatives. In this role, she worked with the Finance Committee to develop and act the climate tax provisions of the Inflation Reduction Act. And I'm so excited she's here today to talk a bit more about it. So Alice, over to you. Thanks so much.
Thanks, Sydney. And thank you everybody for joining. I'm very excited to be able to speak to you all today as from the Majority Tax Staff for the Senate Finance Committee. As Sydney mentioned, Chairman Wyden is the chair of our committee, and it was kind of a very large part of enacting the tax incentives that I'm going to talk about today. So as you have probably heard from previous presenters, and you already know, the IRA is the largest federal investment in climate in U.S. history. And what you may not be aware of is the vast majority of the IRA's climate investments are run through the tax code. So upwards of 3/4 of those investments are actually tax provisions, which means that we are talking about a lot of people kind of having to understand the tax code and its impact on energy and environment policy for the first time in a kind of very wide range of areas, ranging from generation to fuels to vehicles to efficiency and manufacturing. So I'm going to try to cover a kind of a pretty broad suite of those incentives today, with an eye towards kind of what in particular states and localities may be interested in, but just know that there is still kind of a lot more to dive into if there are particular questions that arise after the presentation. But just to set the stage on tax incentives, since everybody may not be used to dealing with tax incentives, and especially if you're a tax indifferent entity like a nonprofit or a governmental entity. Generally, unlike grants, there isn't a dollar cap, which means that you just have to figure out whether or not you meet the rules that are set on the statute and any applicable regulations or guidance to determine whether or not you are eligible. And with certain exceptions in these tax incentives, there aren't upfront applications. So you claim it on your tax return. Those exceptions can include 2 allocated credits that are similar to grants that have dollar or other capacity limits. Those are the low-income communities bonus, which are for solar and wind projects for low-income communities, which has a 1.8 gigawatt per year cap, and what we call the Section 48C credit, which is for building or expanding manufacturing or industrial facilities that relate to clean technologies or relate to reducing greenhouse gas emissions. And that is $10 billion total. So those will function more like grant programs, especially because in many cases they will be paired with the ability to turn those credits into cash, either through direct pay or transferability, which we will talk about later. For all taxpayers that are using the credit monetization provisions, which allow you to either get the credit in cash or to transfer it to another taxpayer in return for cash, these will also likely involve some sort of upfront application to Treasury, not to draw down on a specific dollar amount, but to ensure that everything in the project is in order. In terms of the effective date of the tax provisions, most of them went into effect around the beginning of this year. Some earlier, some and some things that we are still waiting on. But for the most part, they are already effective, unlike some other programs in which you may be still waiting on kind of applications to go out, etc. But even if provisions are in effect, taxpayers may still be waiting on Treasury and IRS guidance to be certain that they're eligible and to know what the proper processes are in order to move forward. So you may still be hearing from people, or you may still be waiting yourself on additional guidance in order to kind of fully utilize the provision. In terms of where we are on Treasury guidance, there is already a lot of guidance that has been released, and I put the link to the IRS landing page for the IRA on the slide. But a lot of that is in the form of regulatory guidance like notices or FAQs, and we are still kind of waiting on more fulsome guidance and indeed kind of guidance on many of the topics that are covered across the tax provisions. So I'm going to start with the kind of more widely applicable provisions that are cover kind of opportunities for not only kind of many businesses, but also newly nonprofits and governments. Treasury and IRS are currently still working on guidance for credit monetization, as I mentioned. There are two forms of credit monetization that are new in the IRA. The first one is called direct pay. For the first time, nonprofits, public power, other governmental entities can directly take advantage of many tax incentives through a provision we call direct pay, which functionally allows the entities to claim the value of the credit as a refund. So by applying to Treasury, entities will be able uh, to treat the amount of the credit as a payment of tax and therefore be entitled to a refund for that amount, even if they do not have tax liability normally. And but these only apply to these types of kind of public or nonprofit entities. And if you find yourself in the position of a state instrumentality or agency, you may want to kind of check what your legal status is because the Treasury and IRS are still working on guidance about kind of the exact scope of applicable entities for direct pay. The second provision is transferability for taxpayers that are not eligible for direct pay. So this is most of your for-profit entities. For many of these incentives, they are eligible for a new provision to transfer the value of the credit to another taxpayer in return from cash from that taxpayer. So you're functionally selling the credit to another taxpayer that has sufficient liability in order to take advantage of the tax credit. This, again, will likely be subject to kind of Treasury review and application, and we are still waiting on guidance on that topic. So going into the specific incentives that you may be interested in, one big one is the investment tax credit that covers a very wide-ranging number of topics. The types of examples here include rooftop solar, include battery storage, geothermal heat pumps, microgrids, etc. And generally, if you meet kind of applicable requirements, including some labor and domestic labor requirements that we'll talk about later, you'll get a base credit of 30%. But there are also these new bonuses that are applicable to the investment tax credit. So, for example, if you're doing your solar project, you can get a base 30%, but then you can get also another 10% adding up to 40% for domestic content. You can get another 10% for energy communities and another 10% or 20% for low-income communities. And this low-income communities adder is more particular because, again, it is subject to an application, and those applications will start in the third quarter of this year, but will likely kind of run through the end of this year. The next topic that many people may be interested in is vehicles. And here there is an extension of the existing EV charging credit, which is up to 30% of the cost of the property with some expansions in order to deal with the fact that DC fast chargers and other kind of per location caps were limiting in the prior version of the credit. But it is also now limited to low-income or rural census tracts, and Treasury is still working on putting out a list of those tracts. The other thing that people might be interested in is there is a new commercial EV credit. This is different than the old EV credit that people may already be familiar with. This new commercial credit is up to 30% of the cost of purchasing a zero-emission vehicle for non-commercial use. And notably, this credit is not subject to the content and assembly rules that you may have heard of that apply to the existing EV credit. This credit also is not limited to light-duty vehicles and includes medium and heavy-duty vehicles, such as delivery vans, buses, trash trucks, etc. So paired with direct pay, this means that municipalities, for instance, can take advantage of this for trash trucks or schools for school buses, etc. And you can see some of the available guidance here. Another topic that people may be interested in is of energy efficiency. There's not a direct pay provision for energy efficiency. Instead, there is a deduction. So businesses can already get this deduction. It is now expanded in the IRA, now capped at a maximum of $5 per square foot, with for deducting the cost of installing certain energy efficient kind of commercial property upgrades, which include lighting, HVAC, and building envelope changes. There is a new option for retrofits, which should make it easier for older buildings to apply so that buildings can use their own energy use intensity instead of having to meet the usual kind of energy use reduction from the ASHRAE 90.1 standard. It can also now be combined with low-income housing tax credits. So again, there's not direct pay available for the Section 179D deduction, but previously governments could already transfer the value of the deduction to a designer, usually the architect, and now due to the IRA, nonprofits can also do so, so that you can work out an agreement with an architect in which some of those savings are passed on to the project. Now I want to kind of quickly cover some of the other sectors. These are business credits that may be applicable to kind of certain businesses that are looking to enter this or expand in this field, but may not be applicable to kind of just your more widely applicable taxpayer or entity. First is on clean generation. We already talked about the investment tax credit, which is available to utilities and developers, etc., for solar, wind, geothermal, biomass, hydropower, etc. But similar to current law, a taxpayer can instead take a credit based on the production of the electricity produced if you sell that power. And so these incentives are generally extended for 10 years or more. But in 2025, these credits will transition to a new technology neutral version of the credit where any zero greenhouse gas emission technology can qualify. For most renewable projects, this should not change the way in which the credits work, other than the longevity of the credit, which has been kind of a big barrier to deployment. The next topic is clean fuels. The IRA extends the current biodiesel and second generation fuels credits, which are blenders credits, through 2024. And again, in 2025, we transition to a new fuels credits for producers. And again, it is a technology neutral credit where you gain a larger credit for cleaner fuels. Both of these transitions will require additional Treasury guidance in the years ahead. The next topic is clean hydrogen, which is a new credit in the IRA. This credit allows for up to $3 a kilogram for the production of clean hydrogen, and this was meant to decarbonize the hardest to abate sectors, which can include aviation, long-haul trucking, and industrial and chemical processes. This, again, is technology neutral, so the cleaner the hydrogen is, for example, if it is based off of using renewable electricity or renewable natural gas, you can get up to the maximum credits. The next topic is carbon capture. There are expanded credits for capturing carbon and either geologically sequestering it or using it in enhanced oil recovery or commercial utilization. These new values may be enough to incentivize more carbon capture, in particular on industrial plants. The next topic is the new energy efficient home credit, which was an existing credit that is now expanded to $2,500 per unit and also allowed for multifamily units so that it scales per unit for these multifamily programs. The eligibility is now based on Energy Star's programs in general, and there's a higher tier added for net zero ready homes. And so in general, this credit is for the building of these new homes. So that and the credit generally goes to those builders. And then the last topic, which many may be interested in, is on manufacturing. The IRA makes very significant investments in manufacturing. The first, as we've already discussed, is the Section 48C allocated advanced manufacturing credit. There is already some guidance on this, and since Treasury has announced that the first $4 billion will start being open on May 31st, there's a concept paper stage in which DOE will be reviewing concept papers and then providing a signal to those who submit concept papers on whether or not they should submit a formal application. These credits are very flexible since they can be used towards the cost of building or expanding manufacturing or industrial facilities that either are producing clean technologies, like a lot of the technologies we've talked about today, whether it's solar, wind, vehicle batteries, etc., or it can be for manufacturing and industrial facility that are regardless of what they're producing, but if it is towards reducing the greenhouse gas emissions from those manufacturing or industrial facilities. The next manufacturing credit is the Section 45X Advanced Manufacturing Production Tax Credit. This is a brand new credit in the IRA that has already started to drive kind of big announcements in, for example, solar cell facilities, and is instead of being an allocated credit or being on the cost of the facility, it is based on each component that is produced. So for each solar cell or wind blade or battery component produced, a certain value credit is provided. And for many of the incentives that we've already talked about, some version of labor requirement is newly added by the IRA. It went into effect at the end of January, so projects that start construction now will have to abide by new prevailing wage and apprenticeship standards for the most part. This means that entities will have to pay prevailing wage, and those wages are available on sam.gov, and there's some initial guidance available from Treasury and the IRS on how to meet those, though we understand that taxpayers require additional information in order to fully ensure that they are able to comply. And it also includes an apprenticeship requirement for using apprentices from registered apprenticeship programs, and those requirements are based on the labor hours or the number of apprentices in certain cases. There is a good faith exception for the apprenticeship requirement in the case that you reach out to an apprenticeship program and they don't have an apprentice available or they don't reply within 5 business days. And there is also an option to cure the prevailing wage requirement, which is intended for entities that have classification or kind of mistakes to ensure that they are able to correct such mistakes in line with Davis-Bacon back pay without fully losing access to the credit. The domestic content applies to the electricity generation credits that we talked about. So that's again, for many entities, that will be for things like geothermal heat pumps or rooftop solar. But for the electricity for public power or for developers and for utilities broadly, this will apply to for most of the electricity generation. The bonus credit is already in effect. That's a 10% adder on the investment and the production tax credits. But there is also newly going to be a phase down of the value of direct pay for these electricity generation incentives starting next year. the statute does provide for waivers due to cost or non-availability of domestic components, but that is something that Treasury has yet again to kind of release guidance on, in addition to needing guidance on the domestic content standards broadly. The next topic is opportunities for individuals, and I'm including these here because they are the kind of a common topic, and you may be involved in consumer education and other efforts. There are two personal use vehicle credits. There's the one that is updated from the prior credit, which is the new clean vehicle credit that is up to $7,500 for the purchase of a new clean vehicle. There are final assembly requirements that are already in effect. So the final assembly must be in North America, and there's been a lot of attention paid on these new content requirements where the battery components or the critical minerals need to be produced from a certain list of countries, and these are likely to go into effect for vehicles that consumers receive after the Treasury guidance comes out, which is expected to be later this month. There is also a new limitation on the EV credit that limits it to taxpayers with adjusted gross incomes of generally 150,000 single or 300,000 married. There is but there are also expansions. In particular, there's no longer a manufacturer cap, so Tesla and GM cars, for instance, that had already reached their cars are eligible again, and in general, these credits are available for 10 years. There is a new credit for used vehicles in which up to $4,000 is available for the purchase of a used clean vehicle. Again, similar to the commercial EV credit, this is not subject to those new content and assembly rules I described. You have to purchase from a participating dealer, and it is limited to taxpayers with adjusted gross incomes of generally 75,000 single or 150,000 married. For these credits, there is already some guidance available, which I've provided on the slide. But again, for the content requirements for new vehicles, those are still forthcoming, and we expect that guidance to be needed to understand exactly which vehicles are eligible. There is also, again, an extension of the EV charging credit, and this is 30% of the cost for consumers with a maximum credit of $1,000 if they're installing in their principal residence. Again, there's also a new limit for low-income and rural census tracts. There are also extensions of two residential credits. One is clean energy, so that's rooftop solar, batteries, geothermal heat pumps, etc. And the other is the energy efficient property credit. There is a kind of significant expansion and revamp of this credit, which generally has dramatically increased the maximum credit available. It is now available to cover up to 30% of the cost of the improvements, capped at generally $1,200 a year, but really $3,200 a year if you include the $2,000 per year that can be for heat pumps, heat pump water heaters, and biomass stoves and water boilers. And I've included a full list of the upgrades that are eligible. There are additional limitations that may be applied to each specific type of property. So if you're interested in those, you should definitely take a look at the detailed guidance. There is also new eligibility that is generally based on Energy Star or the consortium of energy efficiency. So lastly, I just kind of wanted to conclude and say that there is obviously a lot covered under the IRA and we touched almost every energy tax provision that exists in the tax code and made significant updates for usually 10 or more years. And so there is a lot to digest, and Treasury and IRS are hard at work to try to provide additional guidance so that taxpayers and entities can take full advantage of these provisions and have certainty and clarity on what eligibility is. But of course, to ensure that your questions are answered, the best way to do that is to ensure that they have your comments. And so if you or if you're part of an association or a coalition wants to submit comments to Treasury or IRS, my latest understanding is that the notices requesting comment back in November are still open. So those mailboxes are still monitored and you can still submit comments to ensure that that IRS and Treasury are taking into account your kind of specific example when they put out these additional guidance for taxpayers. And with that, I will turn it back to Sydney to close. Thank you, everyone.
Awesome. Thank you, Alice. Like I mentioned throughout the webinar, we do not have a live feature for Q&A, but if you have any Q&A you want us to have recorded, we will work to get responses back to you. So please feel free to throw that in the chat there. And in closing, I just wanted to remind you that we will be posting a lot of these resources on Senator Wyden's webpage. There is currently a page there. If you click the services button, you can navigate down to Inflation Reduction Act and Bipartisan Infrastructure Law resources. We have a few guides already, and we'll be posting more after today. And with that, I just wanted to thank Alice for her time and thank all the speakers. There's been 15 in total today, and we really appreciate all the resources that they put together and the time they took to share. So thank you, Alice. Thanks to everyone, and thank you all for listening. With that, we will conclude the webinar. Yes, Joe, I agree. Thanks, everyone, and we'll be following up with information. Thank you. Bye.